All right, there we go. Hey, friends, how are you? Dan Passarelli here. Today, we're going to talk about how to use unusual activity in your trading. Before we get started, I need to point out options are not for everyone. Please read characteristics and risks of standardized options before trading. Get a copy of that by emailing investor services at theocc.com. Don't trade with money you're not prepared to lose. And everything we're doing here is providing generalized information, not specific to your situation. All right. I see we got a good crowd here today. Unusual activity is a very important topic. So that's probably why we have a good crowd here today. And I see some familiar friends and I see some fresh faces, by which I mean names. And so, allow me to introduce myself. My name is Dan Passarelli. I'm an author of two of the most popular options trading books, with a third one on the way. More information about that in future webinars. I also write prolifically on Substack, record a lot of videos that you can get if you're on the distribution list with Market Taker. They're free. And do lots and lots of webinars and get quoted in the media. Oh gosh, I do a lot of stuff. I'm also a trader. I spent a good amount of time trading yesterday, especially because it was the first Monday after expiration. Those are always busy days, and did some of that today. I trade every day, really. Used to trade professionally on the floor of the Chicago Board Options Exchange, and now I trade in a retail account just like you. And I'm the president and founder of Market Taker Mentoring, which is the global leader in option trader education. We have retail and professional student traders in over 50 countries. Believe that or not, isn't that crazy? And we've put tens of thousands of students through our trading. I presented in front of literally hundreds of thousands of people. And I'm a trading industry collaborator. I work with all the best options friendly brokerage firms like Firstrade, and also all the options exchanges globally as well. And let's see. Yeah. As well as a lot of the media outlets too, as I mentioned before. Outside of trading, I do other things that are important. Trading is very important. Trading can make a huge difference in your life if you are adept with it. But is it the most important thing? No, to me, family is the most important thing. I'm married to my wife, Kathleen, who many of you know. She runs operations here at Market Taker Mentoring. I have my two adult children and my two cute little dogs. Sometimes I have one sleeping on the couch behind me, but she's not here right now. And I do other things. I'm a runner, a foodie, a traveler, been all around the world, whether teaching with my work with Market Taker Mentoring or just for fun. Got a trip coming up in, what's today's date here? Oh my gosh, exactly 4 weeks from today. Oh, goodness gracious. That's going to be good. Going to spend 2 weeks bouncing around the Mediterranean. Looking forward to that. And I'm also a music person. Now, enough about me. Let's talk about the important person here. Let's talk about you. That's why you're here, after all, to make that change in your life by getting more educated with options. Because the more you learn, the more you earn, and you are serious. You invest in yourself, and let me help you continue to invest in yourself. After the presentation today, you can go to markettaker.com two T's in a row, and go to the top right-hand corner and click on Join Free, and that will get you on our email distribution list so that we can send you our weekly video, articles that I write, and invitations to other complimentary online trainings. Not to mention, you'll get a lot of other great free tools and resources. Today, we're going to talk about unusual activity. And we monitor unusual activity by looking at two key things: volume and open interest. It's very important to understand what each of these things are, what each of these things can do, what each of these things cannot do, and how to use each of these things. And there's a lot to it. These are powerful, powerful tools. And I will tell you something. These tools I see people misuse all the time. But after today, you're not going to misuse them. If you haven't been using them, you'll be able to use them. If you have been using them, you will be able to use them better with more accuracy. So, volume, now we're talking about options specifically. Volume is the number of options contracts that traded today in a specific option. So it's not all the options in the world, how many traded. It's not all the Apple options. It's the Apple March 6th 270 calls, the volume that traded in that, or whatever other of the hundreds of thousands of options that are listed. In the morning, when the opening bell rings, or even just before the opening bell rings, the volume is 0 because no options traded yet. Then when an option does trade, it goes from 0 to however many options contracts in that series traded. And that's a word that is kind of bounced around if you work for exchanges or brokerage firms, but it's not a word that a lot of just, regular old normal people use. But it's going to make what we talk about here in this class a little easier to understand. Series is that very, very specific option. Oh, look, Siri, go away, Siri. I see the little Siri's orb making all these funny colors on my phone. I'm not talking to you. Series. Oh, go away, Siri. This is going to be hard. I should probably turn my phone off. Is what we call the very specific option. The I know, isn't it weird? The Apple March 6th 270 calls is one series in Apple. The March 18th 275 puts is a different series. All right. Now that is updated real time. As soon as there is a trade in that series, then you see that number go up by the number of contracts, the volume that traded. Open interest is something different. And that's important to understand. It's important to understand the difference between the two and what each does. Open interest is the number of contracts that traded. No. Open interest is the number of contracts that have been created, opened, and are still open, outstanding. And that is a running total that continues day after day and is not updated real time. Now, what do I mean by contracts that were created? Well, I mean this. You know how, for those of you who have listened to many of my Firstrade webinars, or if you haven't, if you've read an options book or listened to a basic options 101 presentation, what does the guy like me or gal like me, the presenter, the teacher, always do every single time when they're introducing the concept of options? Well, they compare it to an insurance policy, right? You can protect your stock with a put option, and it works like this. You pay a premium and you're protected at the strike price, blah, blah, blah. And it's a pretty good analogy. It really is. Because an insurance policy is a contract, right? Between you and the insurance company. Well, it works the same with options. If I buy an option, like maybe I am talking about the Apple March 6th 270 calls. I don't know if the 6th is, the 6th is a Friday. So that probably is a real contract. If I'm talking about those, if I buy 5 of those calls at whatever premium, I'm buying them from someone else. There literally is a human being somewhere in the world that if I buy them, they sell them and a transaction happens. It's like if you go to Target and you see a cute blouse or shirt and you buy it, you get this thing and you pay the money to Target, the person who sells it, right? It works the same way with options. It's just, it's a little more abstract because it's electrons, but it's the same idea. You're buying it from someone else. And that person may not own it. That person may be getting short the contract. And in fact, for every open long position, there is an open short position. It's not like with a stock. Like stock is not a contract. Stock is something that exists. It is a share of ownership that exists in the world. If somebody buys that, they're buying it from somebody who had it. With options, contracts, a long and a short create an open contract. Okay? So that is what open interest is. And so if today I buy 5 of those Apple March 6th 270 calls, and there were no contracts open, maybe it's the first day that those are trading, I buy them probably from a market maker who sells them to me and it gets short them. I own 5. They're short 5. Now those 5 exist. They didn't exist before then, but now they exist. And so the the volume is 5 because 5 traded today, and that bing automatically shows up on your screen. And open interest is now 5, but here's the rub. It doesn't show up on open interest until tomorrow. Let's look at what this looks like in the option chain here on the Firstrade options chain. This is Amazon, February 20th. And let's look at the 200 strike calls. This screenshot is not current prices. It was taken a couple of days ago. But at this point, this was probably taken. John did this for me. Our head coach, John Kamisic, who does all of our one-on-one coaching. Super smart guy, by the way. Ex-Goldman guy. Brains, charisma. Our students love him. He took the screenshot for me. Those of you who did apply for one-on-one coaching recently when we opened it up for people, those of you who move forward with it are now John's one-on-one coaching students. So these 200 strike calls that John took the screenshot later in the day, there were 3,712 of this very specific series. The Amazon February 20th 200 strike calls, 3,712 of them traded today. Not really today. I mean, today when the screenshot was taken. Now, if this actually was today, if this was a live screen, if I didn't have a position in this and I buy these from another market maker, from anybody, let's say I buy 2 of these, this would go from 3,712 to 3,014 or 3,714. The volume would increase. And that would happen right after I make the trade. What about the open interest? Would that increase or not? Well, it might, but then again, it might not. Because if I did not have a position in them and I buy them from a market maker, if the market maker is long them and is selling them, that market maker is closing his or her position. And so if I'm opening a position and the market maker is closing them, the market maker is just flipping the contracts to me. That would not change open interest. But if I'm opening them and the market maker short them and is selling them to open more, then that would create more contracts and open interest would go up. If I'm short them, like maybe it's a covered call and I'm buying them back, and the market maker is short them and so is opening another position, if I'm closing it and they're closing it, open interest would actually go down. And I know it can be kind of confusing, but it's important to think it through. If everything I said right now resonates, great. You catch on super fast. Or you've thought about it before and maybe I just made it a little bit clearer. If everything I said doesn't quite just resonate yet, well, you're normal. But, it is important to give this some thought as we continue to go through the class today and after, because once you get that basic thing down, the rest starts to click. So traders typically use chart data to make decisions about the future, right? Right before I got on here to teach this class, I was looking at charts and indicators. I spent about 45 minutes doing that before we got on here today. In addition to chart data, traders can also use options data. And notice I didn't actually even qualify that by saying option traders, because even if you're not trading the option, you can still use the options data to make better decisions. But they're really great with option traders. So we need to use option volume and open interest in conjunction with each other. And that is a big, big statement right there. We need to use them in conjunction with each other and with other data to get the complete picture. Here's the deal. Option data is so misused by traders. People will, like, I've met some novice option traders who will look and say, look, the volume in these calls is 5,000. That means people are buying calls. That means this stock is going to go up. Gosh, there is a lot of, faith and loose ends that need tying up there. We need to consider each piece of data as a piece of the puzzle and piece together that puzzle. And we want to avoid false assumptions that can get you into trouble because they make you think that one thing is happening when in fact another thing is happening. And if you just look a little more closely at a little bit more data, you can see the bigger picture instead of getting into a common trap with the false assumption. False assumption number one. If an option trades, it's a purchase, means somebody's buying them. Well, that's not true at all. In fact, I just proved that that's not true. Because for every long option, there is a short option. It is a contract. There must be a long and a short in each party. Now, this party can flip it to another party. If I'm long them, I can sell it to this person. Now I don't have them, but now this person's long it, and this person's still short it. There's always, always, always a short for every long. And selling options is a very, very common thing for retail traders to do. Most of the options that I trade, I'm selling, whether it's calls or puts. And that's because one of the biggest things that I trade are covered calls and cash secured puts. Those I trade every single day. I just wrote a darn book on them. It's not out yet. It comes out April 28th. So, yeah. False assumption number one is a massive false assumption that people get tricked on all the time, man, all the time. Look at the volume in these calls. Oh, this stock must be going up. Oh, no, 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 not true. In fact, if you look at zero DTE data, 0 days to expiration, and you look at spreads, way more credit spreads trade than debit spreads. If people who look at GEX data, I mean, they make the assumption that calls are more commonly sold than bought. False assumption number two. Trades are independent of one another. We could look at some data and here, let's see if that's even on. Hold on. Let's see if there's an example on this thing that we're looking at here. It's probably not really a perfect example on this. We'll come back to that. Trades are independent of one another. Sometimes somebody will look at a strike price and say, oh, Dan, look at this. 10,000 of these puts traded. And it is more common for people to buy puts than sell them, even though I probably sell them more than I buy them. And I'll say, oh, yeah, but look at this other strike price. This is not somebody buying puts. This is somebody selling a put credit spread. They're not worried about the stock going down. They think the stock's going to not go down below that strike price. Or it could be even a little bit harder to unwrap the mystery gift. It might be a time spread where the other part of that trade traded in a different expiration or a diagonal. False assumption number 3. Even if you know exactly what traded and it's a big size, so it's a professional trader, professional traders don't know where the stock is going any more than you or I do. I spent many, many years as a professional trader, and I never knew once where a stock was going with any degree of certainty. Right? I mean, nowadays, as a position trader instead of a market maker, I'm, somewhat better at forecasting stocks. But anybody who tells you they know 100% of the time where a stock is going, they're crazy or they're lying to you, including professional traders. They don't know. So they could be wrong. And sometimes they are. And not only that, even if they did know where it's going, if a professional trader bought a bunch of puts, well, they might not think the stock is going down. They might be concerned that the stock might go down, and they're actually long the stock, so they want it to go up. They're buying puts, but they want the stock to go up because they're still long the stock. There's so many pieces to the puzzle, and that's not to say that you can't put those pieces together. You can, but volume is not enough. You cannot just look at volume. You must take a series of steps to see the greater picture. You need to look at a few different things, and I'm going to show you what those things are. But I will clarify or caveat that even if you take all the steps that I can share with you and see the most transparent picture that I can share with you how to see, the information is always still going to be somewhat incomplete. Now, write this down or take a screenshot. This, if you want to be good at using unusual activity data, these are the steps you must take. Otherwise, don't even think about doing it. First thing that we have to do is observe the volume. Now, this is what everybody knows to do. That's the easy part, the most commonly used part, and a very important part. Look at the volume. But then we must look at the volume in other series in that stock. if 5,000 of these calls just traded, were there exactly 5,000 other options that just traded at the same time on that stock? Or it could have been a ratio, did 10,000 or 15,000 trade or 2,500 trade? It's commonly an even ratio like that, though not always. It's more common for vertical spreads to trade, so just a different strike in the same expiration. But sometimes it's a time spread or a diagonal, and it could be in a different expiration. So you really, really have to look around. Is it a spread or was it just that option? Then was it an opening position or a closing position? Boy, oh boy, how do you find that data? They used to make that available many, many years ago. Now I'm kind of dating myself, but you can tell that I've been around the sun a couple of times with this gray hair here. That's why I'm turning sideways. What do you think? Distinguished? No, just old man. Doesn't matter. It's better than getting old's better than the alternative. Is it opening or closing? These days, it's pretty hard to find out. Pretty hard to determine. But I've got a couple of tips and tricks to share with you to let you know how to do it. Was it buying or selling? Oh boy. Now we're really, trying to figure some stuff out. So, and then, of course, even if we know exactly what someone did, we don't know who that person is. We don't know if they're smart or not. We don't know if they're going to be right or not. And we don't know why they did it. They don't know if it's a hedge or if it's a position trade. So we have to do our normal trade due diligence. Just because some professional trader somewhere in the world bought 5,000 of these puts, let me look at it and let me think what I think about it. So unusual activity is wonderful for getting trade ideas. And those of you who use the market taker unusual activity scanners, which are the genius scanners that I know a lot of you use, I tell everybody right from the start, their trade ideas. Don't blindly follow them. And that's why I have classes that go along with them. All right. So we're going to look at volume. What sources do we use to observe volume anomalies? Well, for one, we just look at it in the option chain. There might be some software that allows you to run scans that you can get, or sometimes there are some news feeds that announce unusual activity or whale trades. But, you don't have any control over those. They just pop up. And if they don't pop up, you don't see it. Volume is relative. Okay? If someone trades 500 Apple calls in a particular series, big whoop. That's not a very big trade. But if somebody trades 500 calls in I don't know, something else, Valero or GE or something like that. Okay, that's something to take notice of. It's relative. So volume is just the first step. Let's say we're looking at volume in Apple here. 1,000, no, not 1,000, 14,324 contracts traded. Now, incidentally, in the 262.5 calls, about the same number traded, 14,000 something. Now, if you're watching this and it's like, especially if it's like in the morning and you see, 14,000 traded here, 14,000 traded there, that could be a spread. And there's a lot of other questions that we have to get the answer to as well. One of those questions is, was that opening or closing? How do we know if the trade is opening or closing? Well, there's nothing out there that can decisively tell us whether it's opening or closing. I talked to some of my friends at the CBOE whose job it is to know these things. And they told me it's not marked opening or closing. You don't know. You just don't know. But here's the trick. Here's one way to know for sure. You can compare volume to open interest because they're two different things, right? One is what happened, the number of contracts that traded today, that's volume, whereas open interest is the number of contracts that have been opened. So logically, if volume is bigger than open interest, we can infer and conclusively that it is an opening position. Why? Because if there's 1,000 contracts that have been opened and 5,000 trade, you can't be closing. All of them can't be closing. 1,000 can be closing, but 4,000 have to be opening. But here's the deal. We can take that a step further and look the next day to see if open interest got bigger or smaller. So that's kind of step two. Step one is if volume's bigger than open interest, yeah, it was opening. If volume is not bigger than open interest, volume changes during the day, but open interest does not. Tomorrow morning, open interest will reflect how many positions have been opened or closed. So right here, Google. Okay, let's play a little game here. Is this opening or closing? These Google 302.5 calls. Was this opening or closing? Hit the Q&A box. Just type opening or closing. Or you can type O or C if you just can't muster up enough energy to type, to move all of those fingers. Well, we have some good guesses here. Here's the thing. Think about this. If there are 400, okay, so we start the day today. And what do each of these number? All I care about right now is the 302.5 calls. When we started the day today, what was volume and what was open interest? Well, when we start the day any day, volume is always 0. Okay? So the one thing we know is that 452 contracts traded today. But when we started the day today, what was open interest? It was 447. That's how many contracts have been opened. When today started, and this is a screenshot from a couple of days ago. I'm saying today as if that was real time, but it's not. Today, when the market opened, open interest was 447, meaning that there are 447 long contracts and 447 short contracts. Okay. If 452 traded, open interest, again, that stays the same all day. There are 5 more that traded than have been opened. So clearly, at least 5 were opening transactions. And that's still a little bit of a convoluted statement. But some of those could have been closing, and some of those could have been opening. How do we know? Well, we take a screenshot, or we write a note on a Google sheet, or we write on a piece of paper to look tomorrow and how much open interest changed. If tomorrow open interest is a lot less, maybe open interest is 10, well, we know that most of those were closing. If tomorrow open interest is like 900, then we know all of those were opening. And if it's 600, blah, blah, blah. However much open interest goes up or down is how many of those were opening or closing. If it's opening, open interest goes up. If it's closing, open interest goes down. How about here? The Spider 681 calls. 51,018 traded today with an open interest starting today of 4,727. Yes, Jan says opening. That is correct. And it could be that some of them were closing, but clearly a lot of them were opening. There's only 4,727 exist, so only 4,727 can be closed, but 51,018 traded. So the vast majority of those were opening. Could have been all opening, but we know at least for sure most were opening. Okay. And we don't have to wait until tomorrow to see how much open interest changed. But I'll tell you what, if you want to start practicing and start getting good at this, do this today. Go to Firstrade, take screenshots of volume and open interest of some things that you find interesting, and see tomorrow morning how much open interest changes. That'll be a nice little study for you. How about here? This is the QQQ 601 calls on this day, which I'm going to call today, even though it's not really today. These calls, 33,383 traded up to this point today. Open interest, which started today at 1,999 and doesn't change today. Was this opening or closing? Who can tell me? Must be opening, right? Because only 1,999 existed at the start of today, but 33,383 traded, way more than have been open, so they have to have been newly opened positions. Okay, so we got that down. Now we can use volume and open interest to make good decisions, right? Okay. Well, let's say a big trader came into the QQQs and sold to open 31,000 of the whatever, February 13th, 601 calls. Not all that traded that day were part of this trade. And, we're kind of just going back to here. 33,383 traded, but imagine that there was one single trader who traded 31,000 of those all in one fell swoop. So, there's still 2,383 contracts that traded that were not part of that one big trade. So those were opening, but here are a couple of questions. A couple of questions are, did the trader own the stock? If they're selling those calls, maybe they have 3,100,000 shares of QQQs and they're selling covered calls. And if they're doing that, that means they don't think the stock's going to go down. They think it's going to go up, but just a little bit. Another question. Did the trader previously have an option position in another series? Are they legging into or out of a spread? And is the trader going to be right? Now, one thing we actually didn't talk about just yet is, how do we know that the trader sold these? I mean, here. Look at this. Did this trader sell these calls or buy these calls? We can't tell from this data. Does anyone know how you can tell? Anybody? What do we have to consult? There's something that we have to consult. The first word starts with a T. Giving some hints here. Nobody? Somebody. Nobody? We have to consult time and sales. Now, this data is not super ubiquitous, You have to look around for it. You have to have a resource for it. Okay? You can't just get it anywhere. But if we know that these calls, that 31,000 traded on the bid, we know that there was a person selling them to a market maker. Market makers just provide liquidity, so we don't care what the market makers do. There's always two parties to a trade. One's always buying, one's always selling. The market maker is usually one of those parties. What we care is what the position traders are doing, not the liquidity providers. So if it traded on the bid, we know that it was a selling transaction, or even if it was closer to the bid than the offer. Now, with the QQQs, I mean, this is only 2 cents wide, so you would have to be on the bid. If it traded at 286, we don't really know. But if it traded at 287, we can bet your bottom dollar darn tootin' that somebody bought it at 287 because that's the market maker's offer. Okay, so now we're actually combining 3 things. We're combining volume and open interest, and did it trade on the bid or the offer? Okay. Now we're actually getting somewhere. Now we're actually starting to be able to extract real information from the market. The only things we don't know is, did the trader previously own the stock? That's pretty hard to do. You can look, I mean, there's some data, but it's not super useful data, in my opinion. You can look at what they call 13F reports. And if there is some, because we don't know who's making this trade. If there is some trader out there who owned, remember, we have to multiply this times 100 because each call is 100, right? If there is some firm somewhere in the world that owns exactly 3,100,000 shares of QQQ, then okay, I can infer that maybe this was a covered call. But, here's the thing. Generally speaking, all those firms have customers. And so the firm is reporting not just for that customer, but for the entire firm. So maybe one customer is long 3,100,000 of those, but they have another customer that's long 500,000, other that's short a million, the data ends up being convoluted. And then to boot, that data is like 3 weeks old. I think it's 3 weeks. So it's really hard to tell. Did the trader previously have an option position? We can maybe infer that by looking at open interest. I mean, if this is a stock, like GM or something that doesn't trade 31,000 typically, and all the other strikes have open interest of 47, 532, 196. And then, there's this other strike that has 31,000. You can infer that they're either legging into a spread or rolling the strike down or something like that. You can infer a lot of information. There's limitations that I'm sharing with you right now, but the information is still very useful. You don't know if the trader is going to be right or not. And in my experience from using the market taker mentoring genius spreads, and I know there's a lot of you who are on our email list, and right now we're not actually, we don't have a presentation coming up on that. We will soon, I think next month, but get on our email list if you're interested in this kind of thing. And I showed you how to do that earlier. But I look at those genius spreads that pop up unusual activity for certain types of trades when they happen, and they're not always right. I get great information out of them. We have a lot of our student traders using it, but it's not always right. So we always want to look at them as trade ideas and then, of course, do our normal due diligence. When a big trade happens, it's an opportunity to either choose to join the trade or maybe fade the trade. You need to quickly analyze and make that decision. And this is what I was talking about. This is our credit spread genius, and this is historical data. I didn't want to put anything fresh up there because I don't want you to think these are trade ideas. So I used a screenshot from December. But these are the kind of things we see. 10,000 of these Nvidia spreads traded. Here's another 10,000 of these Nvidia spreads. 10,000 of the Mara spreads traded. We're seeing the biggest trades that happen by the professional traders. And then, we can see that they traded on the bid. So somebody was selling them. This only identifies credit spreads. So they're all close to the bid. And when you have that kind of information and then you can tell that they're opening or closing by looking at the open interest, you've got some really, really useful information. But you have to be able to put it all together. I mean, you need a tool like Credit Spread Genius or something. Or, put in the time to piece together all this information on your own. Volume, open interest, and time and sales must be used together to better understand market action. Analysis is helpful, but it's not foolproof, but it is pretty helpful. So all that being said, friends, have a great rest of your day. And I will see you next week when we talk about Ooh, high leverage with low risk. We're going to talk about directional butterflies. That is going to be a good one. All right. Have a great rest of your day. Trade smart, and I will catch you next week.